Obviously, a big day for GE as it sort of remakes the company and tries a new tack, Michelle, which is to underpromise perhaps and overdeliver. We're going to be speaking, of course, to John Flannery, the company's CEO, not too long from now, right here from the New York Stock Exchange. But a few things to note this morning. Healthcare is the key asset that is being sent into the public markets eventually. They're going to monetize 20% of it. That will have the effect of raising some cash, much needed for that balance sheet at GE as they seek to de-lever. And I think you're going to get a lot of investors focused as much on the announcement of healthcare as on the balance sheet ramifications overall and what the company's announced this morning. There's a conference call that just began at 8:30 in which they're going to be taking questions as well. But they plan to take leverage down from 3.5 turns to 2.5 turns. Remember, this is a company that, as a result of buying back $26 billion worth of stock in 2016 and 17, added debt to its balance sheet at really a not particularly good time. Now they're trying to take it the other way. Another $500 million in costs is what they're also trying to take out. That is beyond the $2 billion in cost reductions they already had in sight for this year, for 2018. And my sense is they hope to actually outperform on those numbers, again, to this idea that perhaps this is a company now that is going to be under-promising as opposed to, as seemed to be in the past, certainly under the auspices or the leadership of Mr. Immelt, overpromise oftentimes and not really deliver. Healthcare probably dispatched in, let's call it, the next 12 to 18 months. This is not something that happens overnight. Again, 80% of it. It's just a matter of, is it a spin or a split off? But essentially 20% gets monetized, most likely through the selling it into the public markets in some fashion, and then 80% gets given to shareholders, most likely. The key is then you have a really much more focused set of businesses, right? They kind of all seem to make things that turn, to put it very simply. Whether it's turbines, as they like to call it there, in power, or for what really is, of course, a jet engine and the renewables, that becomes the company. What becomes Mr. Flannery's focus? Well, turning around power has already been the case. That will continue to be. Turning that company or that part or that company around as a part of GE. Baker Hughes, we know also over the next 2.5 years, they sell what they own of that, the 62+% into the market. And then it's about reducing GE capital significantly from here. And that 85 billion or so, let's call it 42 billion of kind of bad insurance claims. Most of it made up by long-term care liabilities. Yes.
Mike Santoli asked a good question earlier. A lot of people way back when bought the stock for the dividend. The ultimate industrial, what's remaining of the company, what that dividend is going to look like. They've used this phrasing to match their industrial peers. And do we know, is that a measure? Is that going to be based on a yield? Is that going to be a capture of cash flow? Do we know what the definition of that is?
You know, I don't know a number specifically, but it would be a payout ratio that is in line with its industrial peers. The same way that healthcare, once it is removed from the company, and the dividend will not get reduced, GE is saying, until it has been separated, that being healthcare. So healthcare is then going to have its own dividend commensurate with what its peer group has in that industry. And we're talking about the likes of Medtronic or Siemens, Danaher, Thermo, Agilent, if you want to think about companies that are somewhat similar. And then, yes, you're going to have an overall reduced dividend, Michelle, given what it is now. But I don't know what the number is going to be. It's going to be based on a payout ratio, obviously. The hope is, though, that they can, be freer with capital allocation at the new healthcare company, newly public healthcare company, certainly, perhaps spending more than they otherwise have in the past.
David, what kind of, I imagine it's a bath, I don't know. Did Nelson Peltz and Trian ultimately take on all of this?
Well, they still own it. Right. So, I mean, they're down significantly. I'd have to go back in my very large file here to remember their average cost, Andrew. I think it's high 20s, low 30s, but it's yes, this has not been their finest hour. Now, they are still in there, and Ed Garden, as you know, of course, is on the board. He's one of the co-founders of Trian, and they hope that eventually they're going to exit this thing at some point in the distant future with a profit. I think they still believe that is a real possibility.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.